Welcome back. This lecture will cover Chapter 10, which is Payroll Computations, Records, and Payment. And basically, in Chapter 9, what was discussed included several aspects of business accounting, which included special journals, the petty cash fund, and bank reconciliations. So, in this chapter, Chapter 10, we're going to continue the study of business accounting by discussing payroll accounting. So in section 1, I will cover major federal laws relating to employee earnings and withholdings. So basically, I will explain to you those deductions that usually come in your paycheck if you work for somebody else, if you don't have your own business. Usually you don't get a check that it is equivalent to your gross earnings. Usually if let's say if you earn $400 for the week, you're not going to get a check for $400. It usually comes in at a lower amount, and that's because your employer has deducted some taxes that the employer is required to deduct prior to cutting you a check. So we will be covering what those taxes and those laws are. So let's begin by explaining or defining what an employee is. So in this case, an employee is a person who is hired by and works under the control and direction of the employer. So there are several characteristics of an employee. In most situations, an employee works in the employer's facility, uses the employer's tools, and is under the employer's direct supervision and is it's under its direction. An independent contractor, however, works unsupervised, usually is away from the employer's facility. So, what we will be discussing in terms of withholding for an employee is going to be for an employee and not for an independent contractor. An independent contractor in this case is responsible for paying all payroll related taxes related to income on their own. They don't have an employer, so they are responsible for making sure that those taxes are paid. So, like I said, we will cover in this objective the major federal laws. So, let's continue by explaining the very first one, which is the most significant law, and that is the Fair Labor Standards Act. And this act is sometimes referred to as the Wage and Hour Law. So, the law applies to firms engaged directly or indirectly in interstate commerce. And the Fair Labor Standards Act fixes minimum wage and the maximum number of hours that an employee can work at a regular rate of pay. So, in a nutshell, what this act does is that for any employee that works in excess of 40 hours, must be paid at a 1.5 times the regular rate of pay, or what we commonly know it as time and a half, depending on your hourly rate of pay. So let's go into some of these taxes that we will be covering in this chapter. One of them is Social Security tax, and this is a tax that is imposed by the Federal Insurance Contributions Act, known as FICA, and it's collected on the employee earnings to provide retirement and disability benefits. So the Social Security Old Age Survivors and Disability Insurance provides benefits for employees and their families, including retirement benefits when a worker reaches the eligible retirement age, benefits for the dependents of a retired worker, and benefits for the worker and the worker's dependent when a worker is disabled. So the Social Security Act also provides benefits for a worker surviving minor dependent children and the spouse in the event that a worker or the employee dies. The tax is subject to maximums, which often change, so it is important that as an employer you keep up with what those changes are, and the date that it's effective is very important. So currently the Social Security tax rate is at 6.2%, and the earning base is $106,800. Medicare tax is a tax that is imposed on employees and employers to provide medical care for the employee and the employee's spouse after each has reached the age of 65. The current Medicare tax rate is 2.9%. However, the 2.9% is not the sole responsibility of the employer. In this case, 1.45% of that tax is withheld from the employee's paycheck, so the employer will deduct that, and the other 1.45% of the employee's tax is paid by the employer. So, out of an employee's gross wages, Medicare is withheld at the rate of 1.45%, and the Social Security is withheld at the rate of 6.2%. And the employer pays a matching portion. So the Medicare tax does not have an earning limit, so the tax applies to all earnings paid during the year. So what this means really is not only are you going to withhold 1.5% of the employee's earnings, you're also going to set aside 1.45% of your own money in addition to to match that tax and pay it when it's required. So employers are required to withhold income taxes from the employer's earnings, and federal income tax is an additional withholding tax which comes out of an employee's gross wages. So employees subject to federal income tax withholding may also be subject to state and or local income tax withholding in most states. And there are a few states which don't require employees to pay state income taxes, and those are some of the examples are like Alaska, Washington, and Texas. We are in California, so we are required to pay that tax. So it's important to make sure that if in case you move your business or you open a second business in another state, that you are well aware of those state and local taxes so that you comply with the law. Now, employers must pay the following taxes that are here. So we are required to pay the federal unemployment tax or FUTA, the state unemployment tax or SUTA, and the Social Security tax. Remember, it's half of that percentage that is required, as well as the Medicare, which is half of the percentage that is required. And only employers pay the federal unemployment tax. Sometimes this tax is referred to as the FUTA, so the employer does not pay this tax. The state employment taxes, SUTA, are taxes levied by the state government against employers to benefit unemployment workers or unemployed workers. Okay? Now, the FUTA and the SUTA tax rates are applied to a taxable earnings base. So we will assume that 7,000 is the wage-based maximum. So employers get a credit for state unemployment taxes paid, and it's applied against their federal unemployment tax liability. And the net federal unemployment tax rate in that case is 0.6% or 0.006. I know it's getting kind of messy here, but please be patient. I'm only covering what the laws are, but the actual problems that you will be working on are much simpler. Now, if you are interested in continuing your career in accounting, you could do a concentration or complete a concentration in tax accounting, which will totally dive into all of these concepts even further. So let's talk about workers' compensation insurance. So what is the workers' compensation insurance? And the answer is simple. The workers' compensation insurance is the insurance that protects employees against losses from job-related injuries or illnesses, or compensates their families if death occurs in the course of employment. So in states where it's required, employers pay for insurance that will reimburse employees for losses resulting from these injuries, okay, or compensate families in the event of death. Now, employers must keep a record of the employee's name, address, social security number, date of birth, hours worked each day, how many hours those totaled per week, maybe even month if you pay them monthly. You have to keep track of wages paid at the regular and overtime rates. Remember, because of the act, any hours worked over the 40-hour limit or maximum, you have to pay them at the overtime rate. You have to keep track of cumulative wages paid during the year, the amount of income tax, the amount of Social Security tax that you're withholding, the amount of Medicare tax that you're withholding each pay period, the proof that the employee is a United States citizen or has a valid work permit. And all of this is very important. If you don't keep track of this and you come into an audit and you fail to properly have these records, it may result in hefty penalties for your business, and that's not the way you want to go. So you got to make sure that you keep all these records in place. And that's pretty much it for section 1. Again, it's just talking about the general laws and taxes that are out there. So let's move on to section 2. And the section 2 of this chapter will deal with the actual withholding calculations and the recording of those calculations in the payroll register. So you're going to learn how to actually log in those transactions by doing the normal debit and credit that you have been learning throughout this semester. Okay, so let's move on. So we're going to begin by computing the gross earnings of employees. And the first step in preparing payroll is to compute the gross wages or the actual salaries for each employee. And there's various ways that you can compute this, and it will depend also on the type of the employee that you are hiring. You may hire an employee on an hourly basis, so they may be part-time, and you may pay them 10 hours a week. So it's beneficial that you pay them an hourly rate. Or they may work for you 40 hours per week, but you still want to pay them at the hourly rate. So what that means is that for each hour worked, they get an hourly rate of pay. Or you may hire them on a salary basis. For example, I work as a manager at my current institution, and I'm a salary based employee. So I am guaranteed to be paid an X amount of money per month, regardless of the number of hours that I work. So, and that's because I'm a manager. So and when I say regardless of the number of hours worked, I mean, let's say I take vacation time. I may have vacation that I could log in, and I'm still going to get paid my salary pay regardless. Now, if I worked on an hourly rate, that might be different. So if I only worked 30 hours for that week, I'm only going to get paid 30 hours because I didn't work my 40. So it all depends. You may pay an employee based on commission or the piece rate basis. Okay, so gross pay is calculated by multiplying the number of hours times the rate of pay, unless there's overtime involved. So we have an example here for the week ended January 6th for 2 employees. We have Alicia Martinez and Jorge Rodriguez. Both of them worked 40 hours, but they have different rate of pay. Alicia gets paid $10 an hour and Jorge at $9.50. So you would just multiply the number of hours times the rate of pay to get the gross pay. So for Alicia, it's $400, and for Jorge, it's $380. Now, if overtime exists, remember overtime is anything over 40 hours per week, the employee will be paid at the rate of 1.5 times the normal hourly rate. So we have an example here. We have George Dunlap earns $9 per hour. He worked 45 hours that week. So he is going to get paid 40 hours at the regular rate of pay and 5 hours at the time and a half rate of pay. So we will calculate that by first calculating the regular earnings. That's 40 hours times $9, which is $360. But then we have to figure out what that pay rate would be at time and a half. And all you'll do is multiply 9 times 1.5. So 9, or the rate of pay, times 1.5. And if you calculate that in your calculator, it will give you an hourly rate of $13.50. So you will calculate that rate for 5 hours, which is $67.50. So the gross pay here is $427.50. So let's talking about the withholdings required by law. Remember that the federal law requires employers to make 3 deductions from employees' gross pay. We talked about those. We talked about FICA, the Social Security, and the Medicare tax, as well as the federal income tax withholding. So make sure that we have to know how to do that for this chapter. So let's determine that the employee deductions for Social Security tax. For Social Security tax, remember that we have any wages in excess of $113,700 are not subject to Social Security tax. So later on in this presentation, you'll learn that you have to keep track of how much you're paying your employees throughout the entire fiscal year or the calendar year, depending on your business, because you got to make sure that you stop withholding Social Security tax after they've earned $113,700. Okay? So, if an employee works for more than one employer, FICA taxes are deducted and matched by each employer. Why do you want to know this? Well, when the employee files a federal income tax return, any excess tax is refunded. However, the employer does not receive any refund. Each employer must pay the FICA tax. So to determine the amount of Social Security tax to withhold, you multiply the taxable wages by the Social Security tax rate and you round it off to the nearest cent. So remember that anything above the maximum wages is not subject to tax. So we have an example here for Alicia, Jorge, and George, which we covered in the previous slides. They have their gross pay here. The tax rate for Social Security tax is 6.2%. So all you will do is multiply $400 times 6.2% on your calculator and will give you $24.80. Okay, and you will do the same for the others to figure out how much tax you're going to withhold from their paycheck. In this case, for these 4 employees, you would withhold $109.59. So let's determine the employee deduction for Medicare tax. Medicare tax, remember, there's no limit on the wages subject to Medicare tax. So in this pay period, you as an employee and employer, you're withholding $25.63 from all employees based on your Medicare tax. So in the Medicare tax in this case is 1.45%. So for this chapter, you got to make sure you learn how to calculate these taxes and also keep track of what those tax rates are, okay? And also think about when they're working over 40 hours. Now, this is to determine the employee deductions for income tax. So a substantial portion of the federal government revenue comes from income tax on individuals. So withholding depends on earnings, the frequency of the pay period, the marital status, and the number of allowances. And we'll cover that in a minute. So talking about withholding allowances, the allowance generally refers to the number of exemptions the person is going to claim at the end of the year on their income tax return, usually the 1040 form. So you might know if you work for someone that you have to fill out a lot of paperwork when you get hired, and one of those forms is the W-4 form. this is where you claim how many allowances you're going to claim in that form. And that's what the employer determines for the number of withholding allowances for you specifically. Okay, so what is an employee's withholding allowance certificate form, W form? That's an employee's withholding allowance certificate, and it's a form used to claim exemptions or withholding allowances. So let's compute the federal income tax withholding. And the way that we do that is the wage bracket table method, which is the most common way to compute the federal income tax withholding. And employers choose the proper table based on pay period and the employee's marital status. So let's show you what that looks like. So we have an example here. We have Cecilia Wool is married, claims 2 withholdings on their allowances, and earns $560 for the week. So this is what we have circled here. It's married. This person is married, gets paid weekly. The number of allowances is 2. So you're gonna look at the tax bracket, go to the table, and look at the earnings for the week. This person earned $560. So you're going to look at the earning table that has at least 560 but less than 570. Okay? You always look at the one that has the at least. Don't go to the less than. Okay? And then you go down to the number of withholdings and see where that path crosses. So this is $30. So for Cecilia Wu, there's $30 that are withheld from the paycheck for federal income taxes. Okay. Okay, so other deductions required by law. So most states and some local governments require employees to withhold state and local income taxes as well. So it's very similar in procedure to those for the federal income tax withholdings. And usually you would apply the tax rate to the earnings or use the withholding tables. It's just very important that you identify what those are and comply with the law. So it's basically making sure that you keep yourself informed. Now, we cover what are required tax deductions, but there's also voluntary deductions that an employee may be opting into. So, they're not required by law, but there's an agreement between you, the employer, and your employee. And those are some of the examples are the group life insurance, the group medical insurance, company retirement plans, bank or credit union savings plans or loan repayments, United States saving bonds, purchase plans, stocks, and other investments, and employer loan repayments or union dues. And that all depends on the type of business that you run. You may not even be offering any of these voluntary deductions, but if you do, or in the future you expand your business where you are providing these types of services to your employee, it's very important that you comply with those deductions as well. So now we're gonna enter gross earnings, deductions, and net pay in the payroll register. A payroll register is a record of payroll information for each employee for the pay period. Remember, I said that you have to keep track of all sorts of information from your employee, and this is where you will record it. You may adopt a different way of recording them, so this is just an example for you to consider. Again, you can run your business as you please, but it is important that you keep track of all these records in case you are entering into an audit. So in this case, we have several employees here. We have their name, their number of allowances. As you can see, it varies depending on the W-4 form that they complete. Alicia has 1 withholding versus George has 3. We also record their marital status. Are they married? Are they single? Okay. and also the number of hours that they worked. Notice that some of them worked 40, some of them worked overtime, and the rate, okay? The rate of pay. Let's see, let's go on. So what is cumulative earnings? So since this is the first payroll period for the year, there are no cumulative earnings prior to the current pay period. So this figure is needed to determine whether the employee has exceeded the earning limits for the FICA or the Social Security portion, as well as the FUTA and the SUTA taxes. So in later periods, this column will accumulate the year-to-date earnings, and it's very important that you do so. Remember, there was a limit of 113,700. It's very important that you record that so that you stop withholding that tax after they hit that amount of earning. And this is how you complete the payroll register. Basically, we have Alicia Martinez's Social Security tax table, taxable wages. Tax table is actually the Social Security's taxable wages. We have it at $400 for Alicia, and her wages are subject to Medicare are also $400. Her wages subject for the FUTA tax is $400, and the amount withheld from the from her paycheck for Social Security is $24.80, and Medicare is $5.80. So this is the way that you would keep track of the taxable wages and deductions based on the earnings for January. Okay. And this continues on. So we have income tax withheld for Alicia at $19. So, and then she has no health insurance deductions for this payroll, but there's some for the others. It's just a way of you recording what's happening to your payroll. Okay? You could do this in Excel. It's very easy to do in an Excel sheet. Okay, after all of the deductions, Alicia Martinez's net paycheck is actually $350.40. It's not going to be $400. So after all the deductions that we just covered, you're going to actually cut her a check for $350.40. Okay? And what you can do here is at the end of that payroll, you could total all of your columns so you keep track of how much you should have in each of these accounts for the taxes. Okay, so now let's go on to the third section of this chapter, which demonstrates how to record payroll information for the pay period. And so we're going to learn how to journalize the payroll transactions in the general journal. Okay, so what we're going to do is journalize the payroll and the withholdings, and we will journalize the payroll transactions in the general journal, although they could be journalized in the cash payments journal instead, but we will keep it at the general journal. We use the totals in the payroll register columns as the basis for our general journal entry to record the payroll. Okay, so if you notice back here, we have the totals here. These are very important for us because this is how we're going to be journalizing how much we should be having in each of these accounts. Okay, so let's go for this. So the information in the payroll register is used to create the journal entry to record the payroll. So let's take a moment to review where the debits to the various salaries and wages expenses come from. Okay, so here we have, this is the payroll register. So we have the name of the employee and all the taxes that were withheld, and then how much you actually paid the employee and the check number. So what you're going to be doing is actually debiting the office salaries expenses, okay? And then you're gonna be also debiting the shipping wages expenses, okay? And this is where they come from. However, what you're going to be crediting is all of those taxes that you just determined you were going to withhold from the employee, and you're going to do them individually. Okay, so not as a lump sum. You're going to separate them by Social Security tax, by Medicare tax, by employee income tax, by health insurance premium, if that's what you're doing. Okay, and making sure that they balance. And each deduction is recorded as a credit to the appropriate liability account, okay? So this is where it's coming from. See how we have the Social Security column and we have the ending total as $139.35. Well, when you're debiting it for Social Security, it's that entire amount. You're not going to do it for each employee. You're going to do it as a lump sum for everything, for the whole entire column. Same thing for Medicare, okay? Same thing for income tax, $155, and health insurance is $80. Okay? Okay. So almost all businesses pay salaries and wages of employees by check or by direct deposit. So use these methods and avoid the inconvenience and the risk involved of dealing with currency. You don't want to get yourself involved in that. Always have a official record, and the best way to do that is by doing a check, cutting a check for the employee, or doing a direct deposit if that's something that you offer to your employees. So you're gonna make the you're gonna pay by check, and you're gonna do a journal entry that records the actual disbursement of paychecks to the employees. So some businesses set up a separate payroll account to further protect their cash account. So cash is credited for the net take-home pay. Okay, so if a business uses a separate payroll checking account, then the payment process has two steps. A check is drawn on the regular bank account for the total amount of net pay and is deposited in the payroll bank account. And then the individual payroll checks are issued from the payroll bank account, okay? So many businesses do that, and it is a two-step process, but it's up to you how you would handle that on your end. If you're going to pay by direct deposit, the bank electronically transfers the net pay from the employer's account to the personal account of the employee. So on payday, the employer receives a statement showing earnings, deductions, net pay, and the date of deposit. Okay? So what is an individual earnings record? An individual earnings record, also called a compensation report, is a record that contains information needed to compute earnings and complete tax reports. Okay? And this is what it looks like. So by the end of the month, Alicia Martinez has earned gross wages of $1,600, and the earnings records are totaled monthly and at the end of each calendar quarter. And what this does is it provides information needed to make tax payments and file tax returns. So does this sound familiar, like your W-2s? And that is all, folks, for this presentation. Basically, what you need to do is learn the laws, learn the tax rates, compute the gross earnings, how much tax you're going to withhold based on those tax laws. You're going to learn how to record a record of all those earnings, and make sure you record the transactions using debit and credits, and then keep the earnings records so you can provide monthly updates or calendar quarters so that the employee has a record and you as well to file tax returns. And if you have any questions, please let me know. I'm here to help. Thank you for stopping by.